Global markets didn't stumble today, they were blindsided. Japan, the country that spent 40 years propping up America's financial backbone, just pulled off the most stunning reversal in modern economic history. No warnings, no leaks, just a sudden silent dumping of U.S. debt so large that bond traders are calling it the financial equivalent of a tectonic plate snapping. Yields are spiking, liquidity is evaporating, and the question no one wants to answer is now unavoidable. What happens when the nation that kept America's borrowing alive decides it's done carrying the weight? As the yen slid, bond prices weakened alongside it, creating a pattern so rare that seasoned analysts paused mid-sentence when they saw both curves pointing down. A falling currency typically strengthens demand for domestic bonds, but this synchronized decline signaled something deeper: capital retreating from both sides of Japan's financial architecture. Even Bloomberg's early reporting captured an unusual tone of urgency, noting that the yen had reached depths not touched in nearly a year. Markets recognized the message instantly. Investors were not just hedging risk, they were repositioning around the possibility that Japan's long-standing fiscal foundation had begun to shift. The tension escalated when Finance Minister Satsuki Katayama delivered a stark warning that Tokyo would not tolerate speculative, destabilizing moves. Her statement sparked a sudden yen rebound, the kind of reflexive move currencies make when traders momentarily blink. But the bounce faded quickly, revealing that words alone no longer carried the stabilizing weight they once held. The market tested the boundary she drew, found it soft, and resumed pressing downward with renewed intensity. Investors sensed the weakness not in her resolve, but in the set of policy tools Japan had left to support the currency. The rare dual slide of yen and bonds pointed to a deeper issue: distrust in the government's ability to balance stimulus, inflation control, currency defense, and long-term debt sustainability at the same time. International desks began drawing comparisons to the UK's 2022 gilt crisis, when unfunded commitments toppled confidence overnight. But Japan's stakes run far higher. Its role in global finance is not peripheral. It is central, structural, and woven into the mechanics of American borrowing and global liquidity. When Japan shakes, U.S. debt markets feel the tremor instantly. For decades, Japan acted as the steady hand guiding U.S. borrowing costs by purchasing extraordinary amounts of treasury debt. At its peak, it held $1.2 trillion in American bonds, a position that quietly subsidized U.S. mortgages, corporate loans, and credit markets. Cheap credit in the United States existed partly because Japan consistently absorbed its debt. But rising yields inside Japan have rewritten that calculus. Long-term bond yields surged to heights untouched since the 1990s, with 20-year yields climbing to multi-decade peaks and 30-year yields rising above 3.3%. These domestic yields suddenly offer Japanese investors something they haven't seen in decades: returns at home that rival or even exceed returns abroad. The shift is visible in the flows. Japanese investors sold nearly $62 billion in U.S. Treasuries in a single quarter, an exit large enough to force bond desks to reassess their assumptions about who will finance the next chapter of America's deficits. Analysts at Societe Generale warned that if the outflow accelerates, the consequences could resemble a global market Armageddon. Not because Japan would collapse, but because the world's most reliable foreign creditor would no longer be there to stabilize demand. Charles Schwab echoed the concern, noting that repatriation of Japanese capital could push U.S. yields even higher as America competes for funding it once received automatically. The effects are already filtering into daily life. Mortgage rates hover near 7%, levels that feel jarring after years of ultra-cheap borrowing. Credit card rates sit at historic highs. Auto loans tighten as lenders adjust to a world where money costs more and risk tolerances shrink. Behind each of these trends lies a single cause: fewer buyers for U.S. debt means higher yields, and higher yields mean higher borrowing costs at every layer of the economy. The strain on Japan's fiscal structure amplifies the pressure. Debt stands at roughly 235% of GDP, the highest ratio among major advanced economies. The country faces rising costs for defense, social services, and stimulus commitments, all while managing a rapidly aging population that requires increasing support. Meanwhile, geopolitical tensions with China add another layer of urgency, pushing Japan to fund coastal defenses, strengthen alliances, and diversify supply chains at precisely the moment its financial flexibility is narrowing. Bond auctions offer a revealing measure of confidence. Recent sales underperformed, showing that domestic buyers are cautious even before yields rise further. The government must sell more bonds to finance stimulus, but every additional sale risks pushing yields higher, creating a dangerous cycle in which Japan must spend more to borrow more, even as its currency weakens and its debt load rises. The contradiction sits at the heart of Japan's current dilemma. Strengthening the yen requires raising interest rates, but raising rates dramatically increases the cost of servicing the debt. Avoiding rate hikes protects the fiscal balance sheet, but accelerates the yen's decline, which undermines market trust and raises import costs. Every solution worsens another problem, and every policy lever Tokyo pulls now triggers consequences that exceed the benefit the policy was meant to create. That same contradiction extends outward into global markets. So, Japan's low interest rates have fueled the yen carry trade for decades, enabling investors to borrow yen cheaply and deploy it into higher yielding assets across the world. When the yen is stable, the trade acts as a steady engine of liquidity. But when the yen wobbles, the engine misfires. During a brief surge last year, the S&P 500 dropped 3% in a single day as leveraged positions unwound. With Japan now losing control of long-term yields and currency stability simultaneously, the risk of another violent unwind grows. The deeper shift emerges quietly, in the logic of the market's reaction. Japan built its post-1990 economy on stimulus, low rates, and debt-financed stability. For years, that model appeared sustainable because inflation remained weak and savings remained abundant. But demographics changed, global shocks accumulated, and expectations shifted. The very tools that once delivered stability now appear exhausted. Every yen spent defending the currency or supporting stimulus must be borrowed, yet every yen borrowed weakens the perception of fiscal control. A midpoint realization settles in. The system Japan relied on no longer obeys its intentions. The policies that kept its economy balanced for decades now produce diminishing returns, and markets recognize the shift faster than policymakers can adapt to it. The United States becomes an immediate casualty of this transition. Without Japan's steady demand for treasuries, America must attract buyers through higher yields, and those higher yields ripple through the entire economy. Borrowing costs rise. Corporate debt becomes more expensive to refinance. Federal interest payments consume a growing share of the budget. The comfort of relying on foreign savings to fund domestic spending erodes. Higher yields, however, do not solve the underlying challenge. They attract capital, but they also lift the government's servicing costs, creating a tension that mirrors Japan's own structural contradictions. Both nations now face versions of the same problem. Decades of policy built on cheap money collide with the reality that cheap money has disappeared. Japan's crisis reveals a global truth. The easy money era rested on assumptions that, no longer apply. Demographics shifted, debt accumulated, monetary tools lost potency. The world built an economic architecture that relied on endless liquidity, and Japan served as one of its primary engines. So when that engine sputters, the entire system must adjust. The transition is already underway. Analysts recommend fixed-rate loans over variable ones because, rate volatility is now a defining feature, not just an occasional shock. Diversification into real assets, commodities, and alternative strategies emerges as a defense against instability. Market veterans warn that volatility is not a temporary phase, but a long-term adaptation to structural shifts that honestly cannot be reversed by a single policy move. Japan's retreat from United States debt completes the picture. For 40 years, the United States financed its expansion through a quiet partnership with a nation whose savings filled the gaps in America's deficits. That partnership was stable until it wasn't. As Japan pulls back, the United States confronts a world that will no longer finance its ambitions at discount rates. The unraveling isn't dramatic. It's incremental, relentless, and deeply structural. Mortgage rates rise a fraction. Bond auctions soften. Currency markets shift their assumptions. Corporations face higher refinancing costs. Governments adjust budgets under pressure. Each movement is small on its own, but together they mark the dissolution of an era that shaped global finance for a generation. The final implication lands softly, but unmistakably. The world is entering a chapter defined not by stimulus, cheap debt, and predictable capital flows, but by constraints, recalibrations, and shifting alliances of financial dependence. Japan's retreat exposes how fragile the old system was, and how unprepared the new one remains. America lived on borrowed money and borrowed time. Both are now running out at once. Japan didn't announce an era ending. It ended it. The nation that once held America's financial safety net just tore a hole straight through it. And honestly, the shock is only now hitting the rest of the world. Every dollar Washington borrows, every rate Wall Street prices, every debt auction the world depends on now hangs on a country quietly pulling away after 40 years at the center. If this is what the first move looks like, imagine the world after the second, or the third. Because when the anchor lets go, the entire system starts drifting, and nobody is ready for where it goes next. Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you.